Good evening, everyone, and welcome to the Henry Schein Dental Academy webinar series. My name is Corinne, and I will be your moderator. We are excited to welcome Eric Pook, President of Cirrus Consulting, and Bob Gray, Dental CPA at Pilgrim and Associates, LLC, as our speakers today. They will walk us through tax savings strategies for tenants and owner-occupied dentists alike. Before we get started, we do have a few reminders for you. At any point during the webinar, if you have questions, please type them into the Q&A section of your control panel, and we will answer them live at the end. Henry Schein is not offering CE credit for viewing or attending this presentation live or on demand, and this webinar is sponsored by the Cirrus Consulting Group. Eric and Bob, welcome, and thanks for being with us today.
Thank you.
Hey, Court. Pleasure. Bob, thanks again for being our special guest this evening. As a number of people are joining, it's a true privilege. I've been thinking about this event for quite some time. I had the privilege of meeting Bob pre-pandemic, probably about 3 or 4 years ago now in Napa, and Bob is a great knowledge source on all things tax for dentistry and really dedicated to the improving the quality of life and income of dentists. So 30 years of experience we'll be able to share from Bob this evening. And Bob, I knew you did some business of dentistry, Aruba, Saint Martin, St. Croix. You know what? Why aren't we doing this remotely down on the islands?
Yeah, that was a popular program, and obviously it ended right before the pandemic. And I think that the Academy of Dental CPAs is going to crank it back up again, though. So stay tuned.
It's a good idea, indeed. So now that we've had, as people are joining, first of all, thank you so much for joining us this evening. This is the first Henry Schein Dental Business Institute webinar you've done. We're going to try to flow through a ton of great content tonight. And I appreciate all of you that had emailed me in advance, checking in prior to the webinar with a little bit of background in terms of your situation. Just to take that customization a little bit further, we'll pull up a quick poll just to get a sense. There's been no shortage of great events and great content these days. So just to make it a little extra customized tonight, just take a second here. Question 1, what best describes your current situation? Are you planning to open or relocate a practice? Are you planning to acquire a practice? Are you planning to transition and sell? Are you planning to stay put and renegotiate? Or if you own your own or contemplating buying a piece of real estate, you can mention none of the above. We'll touch on some of the financial components this evening as well for both and pros and cons. Also, number 2, purpose of taking the webinar: general knowledge, looking for guidance, looking for help with lease or tax, right? Or curious about the market rates for your specific area. And then, of course, for those, especially based on those that are contemplating transitioning or otherwise, or simply looking at how to help to protect yourselves, when does that lease expire? Or if you own your own real estate or building. And then, of course, those that are contemplating buying, certainly there's question number 4. And also for those that reach out in advance looking for help or assistance to review their lease, there's a quick section for number 5 there. Keep it simple. Beautiful. So we'll take a quick second. Please give that a quick update, and we'll help to customize that based on the situations. So a true privilege to be joining here with Bob this evening. And let's jump right in, shall we? So today, as you saw, a couple of core components. Number 1 is to help talk about tax. That's why we brought in one of the foremost experts with Bob Gray this evening. We'll also talk about some of the impacts specifically as it pertains to your location and your lease. So a lot of questions about incorporation. I'll talk about it purely from a leasing perspective, as well as we'll talk about relocations, some cost segregation, big hot topic for Bob, tax reasons, talking about buying and selling, talking about leasing tax impacts with, let it blow, buying or building, right? The practice, building and selling your practice, as well as a lot of questions we get, which is, hey, if I'm separating a lease for myself and I plan to either keep it with my practice, or if I plan to sell my practice separately, what could be the better tax efficient method, choosing a triple net lease, gross lease, modified gross lease, and beyond. Perfect. For those of you that haven't heard of Cirrus before, we're pretty unique. We're the only healthcare specialized tenant representation firm of our kind in North America. 27 years in the business, just a couple of years less than Bob. We've had the privilege of working with over 12,000 tenants in our experience. And of course, with COVID or otherwise, we've never seen more doctors looking for assistance, that it be negotiating or renegotiating their dental office lease, or for some guidance on how to create a lease to separate those two entities. Pretty uniquely, we have in-house legal, leasing, and consulting departments and real estate analytics, and have the privilege of working with Schein for hundreds of these type of courses throughout the year. All right, to jump in. So one of the top questions we get are, hey, should I own my own property, or should I lease my property? And let's touch on it from a leasing perspective. Bob and I both have the privilege of being part of the faculty for the Henry Schein's Dental Business Academy and Dental Business Institute that was typically pre-COVID held in West Allis, Wisconsin. And this is one of the core components we always touched on with the attendees. Number one is, of course, buying real estate. The perception is, hey, this could be a lot better in the long run, and it certainly can be, and Bob will touch on some of the financial components. But it also, for those of you that are early on in your careers or otherwise, it does take up a large financial investment, and it could tie up some capital that might be better suited in potentially opening a satellite location, second, third location, and beyond. Of course, you do become the landlord, which has its own pros and cons. Which makes it important that you've done your due diligence. If you're looking to buy that single standalone location and it's a 50 or 100-year-old colonial type of home, just be sure that now there isn't that phone call for someone else to be responsible for the roof, or any of the external components and liability there is. Rental income can be great, passing it from one pocket to the other, and fair market rent is also important, which Bob will as well touch on. And then flexibility, of course, you've got that freedom and control. But the flip side is, and a lot of doctors were pretty happy through the process, they had the lease because they had the flexibility and they didn't have both a mortgage, plus all the other overhead expenses for the practice. So less upfront cost, more flexibility to make sure that this is the right long-term area for yourself and your practice. If you're buying both, you are pot committed for both. And certainly the flexibility to relocate, as we've seen a ton of doctors do, especially now as they start to achieve $250,000 of revenue per chair, and they're starting to see the opportunity to look beyond and potentially to expand into the adjacent suite, or look to relocate down the street, to another tenant or otherwise. So let's do a little exercise. We've got some great attendance this evening. First of all, rate the state of your estate. So if you have a blank sheet of paper, this is a great one to run through some of the basics. Who owns your building? Is it in your name personally, your spouse's name personally, or your corporation? And then equally, who owns your practice? Is it just yourself? Is it yourself and your spouse? What is the specific ownership structure of your practice? Potentially there's a minority shareholder that might be owning a certain percentage as an associate, and maybe your wife then owns the building. And what we've unfortunately seen is a number of cases recently where the doctor has passed away. And those questions of 1 and 2 become very pertinent, because once you take out yourself as the practicing doctor, suddenly now you've got your spouse that owns the building. We had an example where the nephew, was the minority shareholder of the practice and suddenly then bought the remainder of it. And suddenly now you had instant conflict because there wasn't any lease in place. All the financials were garbled together and weren't properly separated. And it just created a mess for that estate to dig through that. So we'll touch on some of the reasons why in both cases, the lease is important, even though you've owned both. Are you paying yourself rent today? How are you structuring that rent? So many doctors say, well, I sort of pay myself what I can when I can, versus a set regimented structure based on not just, well, hey, we've been doubling or tripling our rent expense to purely pay off as much as we can, That as well can have its own share of issues. Is there a lease in place, What type of lease will you set up, Triple net, gross net, gross lease or modified gross lease, what's best for you, and also what's the administration behind it. And as Bob will talk about, what could be more tax efficient for you? And then ultimately, what do your transition plans look like? If you're just about to buy the building, very important early on to have that lease structured now versus in 5, 10, 15 years, or what many do, wait until a time of sale. And of course, for the due diligence team, if the ink is still wet on the lease, right, that's obviously all sorts of red flags. Far better to have a proper lease structured for yourself between your two entities early and often, and then what a benefit when selling to say, well, hey, this is the lease I've had for the past 22 years, right? I'll just assign it on to you, right? So it can be as landlord friendly as possible, especially because you own both locations. So rate yourself, right, on the state of your estate. And very important, if you want to keep your unit or your building as a passive form of income and just sell your practice, right, then proper planning is key. Same thing for the lease. I can't tell you how many doctors miss either when their lease expires or more importantly, when their option to renew deadline is. If there's two things that you can do to put into your phone this evening, it is those two specific dates. And a lot of doctors don't realize that for those of you leasing, if in the event that you miss that 12-month or 6-month or 9-month option to renew deadline period, then unfortunately, those 3 5-year options become null and void instantly. So very important. Ideally, you would complete all your renewal negotiations long before that option to renew deadline. That's the time the gun's to the head to say, look, are you staying or not? Do you agree to everything within your lease with the exception of rent? So one of the strategies as a takeaway from this evening is start early. Ideally 2, in some cases, even with COVID, 2.5 years prior to expiry to help properly structure and renegotiate the lease, especially if there aren't any further options. Asking the question, I won't ask for a show of hands with this one as we usually do in person, but are you personally liable? Have you signed the lease personally? Have you become a personal guarantor? Is your spouse a joint and severally liable? Or is there indemnification language? Right? Have you opened yourself up in the event that the landlord could potentially come after you in the event of a dispute? What happens after you sell? The vast majority of leases, right, of the thousands and thousands of leases we receive, number one is doctors are shocked to know that even after they sell the practice, they remain continually liable. Another thing that impacts both potential of the lender as well as giving guidance to a buyer of your practice is there a demolition or a relocation right? That, in terms of unplanned expenditures, can be deadly to a new practice. So in many cases, the landlord may have the right with as little as 30 to 60 days notice to be able to relocate your practice to any other units in the building or that the landlord may own in the vicinity. Right? And of course, right, good news, when I was reading a lease in Los Angeles, good news, the landlord's going to cover 100% of those expenditures up to a maximum of 2 months of rent. So to build at the new practice at $250 per square foot, or right now in the Bay Area at $400 per square foot, right? Imagine the expenditure of the doctor just because in Article 67, subsection 2, there's a hidden relocation right. So again, rate the state of your estate as it pertains to your lease. So some key components, again, let it be buying the practice, mid-career, or selling, right? These can be critical ones that the lease that you may have signed in 1986 is still the governing document today if you've just continually renewed. So the assignment section, we're going to do a practical example with shortly prior to passing over to Bob. Also be wary of what your rental rate increases have been or are. And many would be shocked to know that if they've never renegotiated their lease, right, every year it keeps going up and up and up. It's like the world's most boring roller coaster. And if you haven't compared it to current market rents, right, we did one in Vista, California recently. We were able to secure the doctor over 30% reduction in rent. She gives a beautiful 5-star Google review. So bottom line is be cautious. And as that rent increases year over year, or if you took some money, some tenant improvement allowance from the landlord, That was not free money, right? That typically is then built into the lease, right? And then, right, you might be paying a much higher than market rate without even realizing it, which then over the past 5, 10, 15, 20 years has gone up dramatically. Consideration is a big one. We had a doctor reach out to us recently that upon the sale of his practice to a DSO, right, was required to pay over $160,000 as an adjustment on close as a payment directly to the landlord because they wanted to redevelop the space. And the only way that the landlord would sign the assignment from the selling doctor to the buying group, right, was for $160,000 cash, right? So unfortunately, you may be shocked to know that in many sections of your lease, there's consideration language, right? Or language that basically enables the landlord to take a percentage of your practice sale proceeds upon sale. In addition, number 4, surrender of the premises. So as we touch on some tax strategies and otherwise from Bob shortly, right? Don't forget to again, just as you're looking through the fine details from a financial planning, right? What about the lease? And many, even those that may have bought a practice, may also be very surprised to know that in the surrender or restoration language in your lease, you may be required to return it to pre-dental condition, which could be a $5,000, $10,000, $15,000 of demolition fees. Because of course, if you're leaving, right, who would rather the landlord pay, right? Would the landlord rather pay for it themselves or you that's potentially leaving or relocating? So be aware of those. Another major point for those of you taking notes from this evening, I can't stress enough to ensure that in your next renewal negotiation, it is critical to have a dental specific clause for something called death and disability. This is language we created about 27 years ago that, you know, as you may know, right, you may have lower back pain, ham tremors, carpal tunnel, etc. You may not be deemed disabled, but you may not be able to, right, practice wet finger dentistry. So therefore, the death and disability clause in essence gives you a right, an exit clause that heaven forbid, if you were to pass away or become incapacitated, your estate or yourself has the ability to say 6 months worth of notice and you're out. Or it gives your estate the ability to help renew the lease in preparation for eventual sale, or at least not be held in default because you, the tenant, are no longer there. So death and disability, you know, there was an example just north of our office where a doctor who was 43 years of age had built a beautiful 6-operatory practice. And unfortunately, 3 weeks prior to the grand opening, it passed away due to a massive heart attack. Fully built out practice, no doctor, no patients. How much is that practice worth? Unfortunately, it got worse. The landlord, 0 was the answer, less than 0 because the bank, right, went after the life insurance, right, to be whole. But then suddenly the landlord said to the estate, to the spouse, to say, unfortunately, as a result of this poor lease, right, it is binding to the successors and the heirs. So the wife was then responsible for the almost $9,000 a month, increasing at 4% for the remaining 9.5 years on the lease. So of course, the reason why we get pretty passionate about this was it took over 6 months to try to find someone to take over that lease because, hey, the blood was in the water and all the surrounding dentists were offering pennies on the dollar. So bottom line is, the reason why we get pretty passionate is had that doctor had some professional representation, if they didn't try to do it themselves, they could have helped to make sure that it protected the estate from what was just insult to injury throughout the whole process. So be wary of that, as well as financial terms. A lot of you may be in default today and be unaware of it. And that's because if, when you asked for help, pre-PPP or otherwise, right, when you were fully shut down, if the landlord asked for your financial statements, right, and you said, whoa, I don't need a deferral, I don't need an abatement, right, I'll just keep paying my rent. But if there was a section in your lease that you were required to provide those financial statements, and in your lease it says that you must within a 10-day period, right, then that you may be in default and unaware of it, which could have impacts to your ability to renew the lease or the ability to assign your lease. So bottom line is, right, be aware of what's in your lease, be aware of what COVID has done to impact your lease, and to help be proactive. So as we mentioned before, these are just some of the main financial variables to be aware of in the negotiation or renegotiation of the lease. In addition to that, good news, on the bright side, we've extended this to a 4-hour event tonight. Bob and I are going to go through each and every one of these clauses in excruciating detail and then go through the entire tax code. Really looking forward to getting into some detail tonight. Bob, no, maybe?
Maybe not. Yeah.
In the essence of time, it's a great one to screenshot. Be aware of it, right? There are lots of components. Be cautious of overholding. Overholding is a big concern that for any of you that are month to month, may be very surprised to know that the landlord can increase the base rent by 150 to 200% and could potentially back bill you since the time that you've been month to month. That happened to a doctor recently in Santa Clara. So bottom line is be aware of these components. If you're not sure, raise your hand, email us, or certainly click the little box afterwards. Happy to do a specific review with myself and the team. This is the last component for practical. Take a quick moment here to have a look at the attached and to help see what potential red flags may be. And by the way, this is found in over 3/4 of the leases we review. So for those of you following along, you can compare side by side. Usually at this point, Bob, we walk around and say, who enjoys reading leases in the first place? So here is typically the assignment or subletting clause in the lease. The first one to be aware of is that right here in the first line, it shall first have received the consent of the landlord. So yes, you will be unable to sell your clinic, typically always a condition of sale, without the successful assignment of the lease, number one. Number two, you ask the landlord, I want to sell it to Bob Gray. Bob Gray is the buyer. I go to the landlord and say, look, Bob's a great guy. I've sold my practice and can you assign the lease? They have 3 options. Number 1, approve Bob. Number 2, decline Bob. Or number 3, terminate my lease just for asking to sell it to Bob. So on whatever the closing date was, the landlord has the right to terminate my lease and go directly to Bob to say, hey, Bob, how much were you going to pay for Eric's practice? Good news, right? Now we can start from scratch. We've got a fully built out practice. How much more do you want to pay in rent as a result? This is another one, right? The landlord has the right to revise the minimum rent paid during the remainder of the term to either the then fair market rent or 15% greater. Bottom line, the landlord can't lose. And imagine what Bob's response would be as a buyer if at the 11th hour, the landlord decided to dramatically bump rent, which throws off all of the practice analysis and all of the valuation numbers you ran previously. And last but not least, is a major component, second to last but not least, is this is the consideration language, which basically says, should, right, myself, the tenant, receive from the assignee, Bob, any rental income, cash, goods, or any form of consideration in connection with the assignment of the lease, right? Therefore, sale of the practice. The difference, paraphrasing, right? Skipping ahead, the difference between the annual rent, right, and the cash is then to be paid to the landlord within 30 days of sale. Therefore, all the planning, all the preparation, etc., can fall to the wayside with a simple sentence in black and white buried in page 96 of 102 pages of the lease. And also, upon transition, notwithstanding anything to the contrary, the tenant shall not be released from its obligations under this lease and shall remain liable for any failure of the tenant or its assignees or subtenants to observe in each and every covenant on the lease. Bottom line is, you are still continually as liable today as you were, right, as you are after you sell the practice. It's akin to signing a car lease for your neighbor's kid, teenager, and then moving out of state, right? So these are the type of things, again, to be aware of, and is found in about 75% of leases. So one particular clause, one example of the 20 to 30 you saw earlier that you really want to be conscious of, aware of, and be proactive with. It's far easier to deal with and renegotiate or adjust and amend now, while you've got 5, 10, 15, 20 years prior to eventually selling, than it is, right, when you're just about to sell and it's the 11th hour. Cost of the mistake goes without saying, could be hundreds of thousands of dollars. So, you know, and lots of examples. This was a great 5-star review of, right, another Henry Schein client who had built out a beautiful clinic, had been there for years, and at 74 years of age was forced to relocate purely because the landlord refused to relocate her, or sorry, renew her lease and assign it in terms of preparation for sale. So she hired us, we moved the practice 10 minutes north, we got the landlord to cover all of the build-out costs, which, I mean, was helpful. But of course, imagine being 74 years of age and being forced, the only way to sell and pull out the value was to have to relocate the practice. So a bit of a cautionary tale to be prepared, and just one of the 200 5-star reviews that gives these type of practical examples that you can see on our website or Google. So bottom line, how do you help to approach this? Right, just as Bob will share, being proactive, helping to get things in place as early as possible. We typically suggest starting 2 to 2.5 years out prior to renewal to give you as most leverage as possible. What do landlords do? They wait. You reach out to them 2 years in advance. Oh, no, it's too soon. We'll wait. Suddenly it's 12 months. You know what? We're still waiting to see COVID. Oh, my goodness. Right? Then suddenly 8 months pass through. That's your option to renew deadline. Right? You still haven't renewed. Now suddenly the landlord, your options have become null and void. You're now in the red, and the landlord can come back and say, here's a 30% rent increase. Right? So we firmly believe starting early, right? Because the landlord has just found a way to dramatically increase their profits without a penny of additional expense at your expense. So the process to get ahead, again, as we wrap up here and pass to Bob, number 1 is get all the information. Let it be PPP or otherwise, right? You want to have a copy, a digital copy that's countersigned by you and your landlord. And you can email them tonight to say, hey, send me a digital copy of my lease, and they'll send that back. Get all the facts, get all the details. Another doctor I was reviewing a lease for in Texas, all he had was the assignment agreement. He didn't realize that when he bought the practice, there was a lease going back to 1992 that was giving all the governing information. So get all the information first. Number 2 is really figure out your long-term plans. What's your objectives, right? What does that look for the career? What investments are you looking to have, and what impact does that have? What's your transition plans, timelines, etc. Number 3, right? Have your lease reviewed. If you haven't had it professionally reviewed, I strongly encourage you to take advantage of that. Number 4, right? Have the data. If you're just a little curious about the impact of COVID and vacancies and rental rates, or even demographics for certain areas, right? Give us a request. We have all that proprietary data coast to coast, plus all the deals we may have negotiated in your area as well. Number 5 is figure out that carefully choreographed game of chess to be what are your top priorities for your next negotiation, what are your nice to haves, and what are things you're willing to concede in order to help obtain your must-haves, right? But unfortunately, what happens is they skip. Most doctors will then skip section 1 all the way through section 5, and suddenly pick up the phone and call the landlord to say, hey, I just watched a webinar. I'd love to start renegotiating my lease, without any of the proper preparation or due diligence or professional guidance. So I can't stress enough, right? Follow the process, learn from our 27 years of experience, and then, right, properly negotiate both the financial and business clauses with dental specific language, right? And then don't stop until there's a final form lease that you're satisfied with. So again, appreciation of the time as we pass over to Bob. We've got a quick poll to make it easy. Click yes if you've had any concerns or even just some particular clauses. Happy to review those. Happy to ensure that you can ensure that you're paying fair rent, as well as if you think that any of these clauses may be in your lease, certainly feel free to pass those along, and we'll spend an appreciation for this for the next 30 days. For anybody that does attend, we're happy to do a complimentary lease review, waive the 1995 value for it, and be able to spend multiple hours in preparation for you and your clinic. On that note, perfect timing as we reach the midway point. It is my true privilege and honor to introduce Bob Gray. Bob Gray and I had some great time together in Napa. The legend preceded him, and certainly for every single one of our mutual clients, swear by his advice. And it's a true privilege to have Bob Gray joining us this evening. Bob, over to you, sir.
Thank you, Eric. Appreciate it. So we're going to go into the tax planning portion of this. A little disclaimer here from Henry Schein, where obviously go to your own professional for tax advice. We're trying to just queue up ideas here for you to consider tonight. I am Bob Gray, and I was proud to be one of the founding members of the Academy of Dental CPAs, also as Eric, an instructor at the Dental Business Institute. We have done a lot of lectures around the entire US. So I think that's how I got invited tonight by Eric. Next one of those, Eric, if I'm not, however, doing accounting, my wife and I love going out to Napa and chasing those little magical 100-point wines. And when I'm not doing that, next, Eric, is a crazy car that I've like to drive on the track. It's a little over 900 horsepower. My wife thinks I'm crazy, but she tolerates it, so it's great. It's a fun time when you're not doing accounting. A quick shout out to the ADCPA. I don't know if many of you have heard of the ADCPA or you know who we are. We're all over the United States. If there's a map coming up here on the next slide that shows you where all of these firms are. If you want to find an accountant who really can help dentists, go to adcpa.org. Again, there are many members of the firm, but they're all accounting firms that are dedicated to helping dentists. And I think you're going to find that that's a specialist would be really, really helpful to you. The people ask me all the time, though, Bob, what's the difference between a regular accountant and a dental accountant? Aren't they all the same? Aren't the tax rules the same? But I would tell you that so many times we hear clients say, well, my accountant doesn't really know what I do. My accountant doesn't really understand. And I would tell you, if you find an accountant who knows mesial from distal and can point to tooth number 8, you'll actually wound up better hands, I think, than not. So we're going to talk tonight about the tax planning considerations. I'm going to start out with what's called the QBI deduction. We're going to talk about accelerated depreciation and some other tips here. I want to go into cost segregation studies tonight, and I know that Eric had mentioned those in the beginning. One of the things I want to start out by saying, though, right in the beginning, is Eric had mentioned the question about lease versus buy. And I wanted to throw my little 2 cents in on that. I would tell you that for many, many clients, it's very, in the beginning of your practice, unless you have a very specific plan, you're almost always better off to lease in the beginning. We've had several clients through the years who thought, well, gosh, I don't want to pay a landlord. I want to be the landlord. And they'll build this beautiful 4-operatory practice. And all of a sudden, they're in year 7 and they've outgrown it. And now they're like, well, Bob, I don't have any place to expand. And what's the cost going to be? And I own this building. And trying to sell your building to either expand or do something else you have to be certain that you are building it for a long time. You want to be in that building for 10, 15 years to really, really get the benefit of it. So that flexibility aspect that Eric talked about in leasing is really one to consider. When you're sure you know what it is you need and what it is you need for a physical space, buy a building, be your own landlord and build up some equity. But that's my little take on that the buy versus lease. Let me talk about the QBI. So back in 2018, when Trump changed the tax rules, they created this thing called the Qualified Business Income Deduction. A lot of people don't really know exactly what it is, but I would just tell you that it's a 20% deduction on earned income, not from a W-2. It's a business income. And that's really important because if I'm an S corporation, I really have to plan carefully. Let's say I had $300,000 worth of profits from my S corporation. Then if I took a $300,000 W-2 that year, I would have 0 K1 S Corp income. But it's the K1 S Corp income that is subject to this 20% reduction. So the first question everyone asks me was, well, Bob, why don't I just take $1 salary and let all the rest of it flow through my S corporation? But the IRS says you can't do that. You have to take a reasonable salary. But a reasonable salary, if you plan on the low side, will help you maximize the K1 deduction, or the K1 income, and therefore the 20% QBI deduction. We're going to talk more about how to plan that QBI and how to maximize it in slides coming up. But I wanted to just set that stage so that everyone tonight has that QBI thing in their mind as we're going forward. Remember that if you're a partner in a partnership or a sole proprietor, all of your income is subject to this 20% QBI. There are limits on the QBI for total income. Well, again, we'll talk a little bit more in detail about that. And I do get a lot of questions about PPP loan forgiveness, but it has no impact on your QBI deduction one way or the other. So PPP loans and things like that are not going to affect. Let me talk a little bit about bonus depreciation and deduction, right? So many years ago, they came out with section 179 of the IRS code. And back in the day, it started out, it was only $25,000. And it was a very minimal deduction. It wasn't really a big deal. Through the years, section 179 has increased dramatically. And for 2021, you can actually purchase $1,050,000 worth of equipment and deduct all of it in the year you bought it. Now, that spending cap, you can't buy more than 2.6 million. So this keeps really large companies from using the section 179. But later on, they came out with what's called bonus depreciation. And bonus depreciation is really just a different form of fully 100% deducting equipment or things that you buy that should otherwise be depreciated over time. And the bonus depreciation for 2021 is unlimited. Unlimited. So whatever you bought in 2021, you can just elect to say, hey, I'm going to tax deduct it this year. It does have to be placed in service before 2022. So it can't just be a check that you wrote. It's got to be equipment that was actually plugged in, turned on, or ready to go. The reason that the difference between this section 179 and bonus depreciation is important is because different states treat them differently. Some states have their own section 179 rules, and they may be limited, for instance, to $25,000, and maybe they froze it at the old level. Some states don't cooperate with bonus depreciation. And so those are the states in which maybe 179 would be the better choice rather than bonus. So again, but for federal tax purposes that you have the option of writing off anything purchased through 21, and this is actually extended into 2022 for 100% bonus depreciation. So again, remember that you don't want to do that for if it's going to create a negative income. We're going to talk about that, but I always get the question, well, isn't this just for some type of corporations? Isn't this, if I'm an S Corp, how does it work? I would tell you that the ability to write these things off applies to everybody. If, we talk about an LLC or a sole proprietor that you write off 100%, but an S Corp, if you in fact plan your salary correctly, and let's say you bought $100,000 worth of equipment this year, you would just reduce your salary by $100,000 in order to take advantage of that extra deduction. And that's how you would tax deduct it. C Corps can do the same thing, but again, you have to actually make sure it's all salary that you've reduced in order to make sure that you pick up the deduction. But anytime you're reducing your W-2 salary and your wages, you're getting the tax deduction for that equipment. It's not really the practice, so to speak. It does flow through to you. So it is all entities. Eric, I'm going to show the example that I had up here for the QBI. So let's start with it in the left column. It says without section 179. So let's just say that this is a practice that made $470,000 of net income. And I bring that out because at the top, you'll see that for the QBI deductions, you're limited for joint taxpayers to $429,800 of taxable income, or it phases out after that. So you want to try to keep your income down below that number in order to qualify for this QBI. So again, in that saying that, go back to that column without section 179 or bonus depreciation, think of them as one and the same. If I had $470,000 of income, but I had $30,000 in itemized deductions, I wound up with $440,000 of taxable income. and $103,590 of federal tax. Well, look what happens if I, in fact, took a $120,000 deduction for equipment that year. That drops my income from $470,000 down to $350,000. And look what happens. Because now it's not just the effect of the income tax on the $120,000. It also brought me down into that category where I'm eligible for the QBI. So I got not only the reduction in income tax, I got a $70,000 QBI tax deduction because I now planned and brought my income down into those limits. And look what the effect was, a $55,000 or 46% basically return of federal income tax because of that $120,000 investment. So I started out by talking about QBI because I wanted you to see this example and realize how incredibly important this can actually be to balancing your income. Okay, you want to make sure that before the end of the year comes, you knew what options you had and what, how you could actually steer the bus to get to this sort of an outcome. Skip ahead there. One of the other tax considerations we talk about in practice expansion, I'm always surprised by the number of people that don't think about space they may have rented in the beginning, and now I'm moving to a bigger space. And they forget that one of the big tax deductions they have, the potential, is the write-off of all of the unamortized leasehold improvements. Eric, I have a sample, I think, on the next slide here. We're talking about, it's called the loss from abandonment. But as an example, let's say you put $300,000 of leasehold improvements into a lease space, and unfortunately, you didn't do a cost segregation study. We'll talk about that. And you've been depreciating it over 39 years. Well, if you went to leave the office 10 years later, you could take an immediate tax deduction of $215,000 for leaving all those leasehold improvements behind. So again, that can be a huge help in terms of the cost of actually relocating when you figure the tax benefits of abandoning the things you did before. Skip ahead, Eric, and I want to talk about the benefits of cost segregation study. I call this really how to turn studs and drywall into Section 179 expenses. On the next slide, you'll see there's an example of just a simple $1 million building here. And a $1 million building, because they say 39 and a half, but it's really half a year and in the beginning and a half year at the end. So it takes 40 years to really get it all. Call it about $25,000 a year for 40 years. And that's under the rules the IRS created many, many years ago. Commercial buildings have to be depreciated over 39 years. But the Hospital Corporation of America fought the IRS in a court case many, many years ago and won. They said, listen, if I'm going to build a hospital and we're going to have flooring and ceiling tiles and all sorts of things that will never be here 39 years from now, why do I have to depreciate it for 39 years? So as a result of all the litigation and the final court case, the IRS came out with the guidelines for these cost segregation studies. And it's where you're breaking the building down into its meaningful components. Then those components are depreciated on their real useful life. And that's a huge difference. Because with a cost segregation study in this example, look at the difference. This would create $80,000 in tax savings in the first 5 years. And when do you need the tax savings the most? It's when you just built this big building, you've got a big mortgage and you've got a lump in your throat, right? And now the 80,000 is the time in the beginning when you could really use these advantages. On the next slide, there's an example of just the sort of the calculations. We won't go through it all, but I brought this up to just to show you again. In the left column where the green is, you can see that it's broken down into various components. And on the right side in the yellow column, it's not. And then you can see the comparison and the benefits of doing these. These studies are performed for free as speculations by many of the companies that do these analyses. On the next slide, you'll see that it's not only a building that you own, but it could also just be tenant improvements. And so it's on tenant improvements, sometimes the ratio is even higher of items that will be pulled into a 5-year property. Let me show you again here. If you remember nothing else tonight, just remember those two blocks. If I break my building down into multiple pieces, some of which are eligible for rapid depreciation, I can tremendously save income taxes. Eric, on the next slide, I want to show a picture. This is just to give you an example. When I ask people, what is this? They say, well, duh, it's an outlet. Well, no, it's not. You have to know what's plugged into it, because if it's a computer that's plugged into it, now it's a computer. And not only the outlet, but all the electrical wiring, even part of the electrical permits and the building permits. And this turns into a $380 electrical outlet. And now it's equipment, it's not a building. Because it was plugged in and used for a computer, it is a computer, subject to Section 179 and immediate write-off. Skip ahead, Eric. I'll show you, there's a sample quickly of a lighting sconce. Is this building or equipment? Well, again, because it's not functional part of the building, it would be immediately deducted. In the next slide, you'll see that all the infrastructure, all the plumbing, all the electrical things that go to dental equipment are dental equipment subject to Section 179, immediate tax deduction. On the next slide, you'll see that one of the things that doesn't qualify is the actual load-bearing walls and the roof. And the next slide shows that the one thing that's never qualified is land. So you're never going to be able to tax deduct land. But just remember that if you've done a building project, you definitely want to consider a cost segregation study. One of the really interesting things about a cost segregation study is that you don't have to do it in the very first year. Think about it. If I just built a building, I probably also bought a lot of equipment, right? Or maybe I have a ton of tax deductions. And if you notice on the left, that's just the current income tax brackets for federal taxes only. You know, I have a doctor that came up to me one time in the Dental Business Institute and said, well, Bob, I didn't pay any taxes at all the year I built my building. I smiled, but I wanted to say, well, maybe that wasn't really the right thing to do, because taxes are on sale when they're only 10 or 12%. I would argue that if you used some of your tax deductions from your brand new building to save taxes that were only going to cost you 10 or 12%, you might have made a mistake, right? So if you can see on that 12% bracket for married couples, it could be up to $80,000, and you're still only paying 12%. Save those deductions for a time when you would be in the 35 or 39, or who knows when Biden gets done with the tax brackets, what they will be, but save them for the days when you're in a bigger bracket. So the beauty of timing these studies is that you could actually wait and say, well, I'm going to use my equipment to get my taxable income down in year one, and then I'm going to come back in year two, and I will pick up the cost segregation study and take both year one and year two depreciation in that second year in order to reduce that. So I think that's really, the key. Again, plan your tax deductions so that you minimize taxes over all of the early years of your building. Again, tax planning is complicated, don't wait. I had to throw in here, I don't want you to forget your PPP loan forgiveness. Remember that you had only 10 months after your 24-week period to pull that, to get the application in. Just don't put that in a dusty drawer somewhere and let that PPP loan wind up to be a loan you have to actually repay. And don't just automatically take accelerated depreciation. Look at your tax and make sure, again, that you're not taking some of that depreciation down in that 10 or 12% tax bracket. And again, you definitely can turn studs and drywall into equipment. So if nothing else, remember cost segregation. I want to leave a lot of time for questions and answers, because it always seems to come up at the end. And we really want this to be valuable for you listening here tonight. If you have some specific questions, both Eric and I are happy to field them. So we left plenty of time here at the end, I hope. Eric, do you have questions?
Yeah, just as a reminder for all the attendees, feel free to add some Q&A through there. One of them, Bob, that was part of the earlier section is for those of the attendees who do own both the building and the lease. You had certainly discussed with me in the past the value of setting it up as a triple net versus other gross versus modified gross. Do you want to touch on that a little bit?
Sure. So in my opinion, you clearly want to set up your own lease as a triple net lease. Triple net lease basically means that the tenant is paying all the expenses and all the cost of maintenance, repairs, taxes, insurance. And so the thing is that the thing that would make that lease unpredictable for you as the landlord is not knowing the cost of repairs or the cost of maintenance. Is it going to be a bad year for snow? Am I going to wind up with a lot of snow removal costs, or wherever you may be? Those kind of things can be the unknown that can really kill the investment or just reduce the benefit of the investment. If in fact you have a triple net lease and then you sell your practice, and again, the buyer inherits this triple net lease, the buyer is then making this building a very predictable source of income for you because all the unknowns are paid for by them for the most part. There could be some major structural, roof things you got to make sure you're on top of, but all the regular maintenance and all the regular costs of operating that building are now paid for by the buyer. And that, again, continues to give you as the landlord a nice little rental income to supplement the sale of the practice.
Got it. Great. Now, another question, again, reminder for all those, almost everyone's remained on. So the Q&A section's open from an anonymous attendee. Bob, what's the latest time frame that you can do a cost segregation analysis? How many years after construction, for example? You mentioned you don't have to do it in the first year, but how long can you bend that bamboo?
Yeah, so you typically want to wait no more than 5 years to do it because that was where all the accelerated depreciation was. I've seen people that said, well, I could go back and pick up, even 6 and 7 years, but you start to lose with the benefit, part of the benefit was the time value of money. And so I would say if you've got somebody listening tonight who built a building 10 years ago, now it would really depend on the nature of the project and that sort of thing. Feel free to email me. Our email addresses are up there. If we have questions we can continue to help people with, I will. If you ask me a question that takes me 2 hours to answer, I'll cry foul, but I'm happy to try to help any individuals. Eric, let me also point out for the rest of I know you said there are people that own their own building that were listening tonight. Remember, one of the things that I wanted to bring up is called a grouping election. Let's say you own your practice and it's an S Corp. And let's say that you own your building in an LLC on the side. One of the things you have to be certain to do is make what's called a grouping election. Because in that grouping election, now the building and the practice profits are one and the same. In other words, one can be deducted from the other. If there were a loss on the building, for instance, now it's not just passive rental loss, it's active business income. And it's also subject, the net rental income, when you group those together like that, becomes subject to that 20% QBI deduction as well. So again, grouping election, remember to look for that on your income tax return and make certain that that has been picked up.
Yeah, great point. A bunch of other questions flew through. Dr. P is about to build a $2.5 to $2.8 million practice to start around January 2022. Bob, when would you recommend doing that cost segregation analysis?
Well, the cost segregation wouldn't even potentially begin until the day the occupancy permit was available, right? Because you're not going to be depreciating your building until that day when you're allowed to turn the key. So 2022 would be the year that it would be the first year to consider. But again, depending on how many things relating to that building, if you're paying for a lot of equipment and moving costs, et cetera, if you could get your income down, again, with other means into that $100,000 category, let's say where taxes are still on sale, you might want to wait till 2023 to do the cost segregation study when the practice revenue will have ramped up, your taxable income will probably be higher. We certainly hope based on the new building. And that seems, again, that 2 to 3 year, in year 2 or year 3, after building the new building seems to be that perfect sweet spot, again, depending on how much equipment you've purchased.
And Dr. P, I would depend as well, right? As a good reminder, if you're leasing that space as well, which might be a possibility, that study can also be helpful, right, for all the leasehold improvements there as well.
Correct. Regarding, even if you're doing a build out, and remember that I said in that cost segregation study, the things that don't qualify are land and load bearing walls, right, and roof. So when you go into a leasehold improvement, you're really not doing any of that work for the most part. It's pretty rare to change load bearing walls when you're doing some improvements. So what happens is when you do leasehold improvements, almost all of those things qualify for rapid depreciation if you do a cost segregation study.
So Bob, this is one that is good for both of us, which can impact rent or audits or otherwise. This is a doctor that owns their building. Do I have to give myself a lease?
Well, again, do you have to? No. Do you want to? Emphatically and absolutely yes. Again, I know that Eric pointed out a couple things, but one of the things that you want to clearly establish is, the value of that building and that rental value, because, God forbid something happens to you, but I would tell you that very few practices sell with the building in the same year or right away. It's very difficult for a young doctor to buy a practice, come up with the money they need to do all that, and come up with a down payment. Most doctors can get 100% financing on the purchase of a practice. You can't get 100% financing on a building very easily, let's put it that way. So coming up with a 30% down payment to qualify for a commercial mortgage is very difficult for a doctor who's probably still got a couple $100,000 in student debt and now is buying, in debt to buy the practice. So it's very typical for the selling doctor to be the landlord for a little while. And again, it help the young doctor and also have some rental income. The thing is, if you don't have a lease in place and something happens to you, again, death, disability, whatever, there's nothing for them to actually acquire. You have to go create and start from scratch. And if you had proven in all those years before what you thought the true fair market value of the building was and had an adequate lease in place, you'd have been way better off. So.
A follow-up to that is rent, right? And the proper assessment and fair market rent. So a follow-up here, Bob, could they triple market rent? Could they quadruple market rent, right? And basically make more expense from one versus the other because you're paying it from one pocket to the other. What can you share about how to properly structure, how to set rent?
Yeah, so I think it really does need to be fair market value. And I think if you say, well, do I want to squeeze fair market value to the very top limit? That's probably okay. But you don't want to underpay yourself in rent. That'd be the big mistake. But clearly keeping it within fair market limits or right on the high range is best, because it doesn't really help you to cannibalize the profits of your practice in order to pay and make your building look more profitable. Basically, it's all going to wind up in your income tax return anyway. And all you're doing is making your practice look less valuable, because profit is a main driver in practice valuation. So you don't want, again, to help the building to hurt the practice.
And from that perspective, again, if you haven't already, that complementary rent analysis and lease review, important. We have all the specific data to make sure that you've got tangible examples and evidence based on all the factors in the area to help make sure that lease is structured properly. So again, Bob, perfectly put, right? Do you absolutely have to have a lease? No, but absolutely should. So definitely follow up, and happy to have a discussion with you there, Doctor. Another good question on the tax side, Dr. C for you. Bob, is there a benefit to taking a distribution from the S Corp versus leaving the cash in the business? Great question. As doctors are figuring it now, a lot of them had a huge rebound on the second half of their Q3, especially last year. But the question about how do I, again, pay myself, when do I decide to keep it in versus taking it out, especially those who might be getting closer to transitioning? What would you share there, Bob?
Sure. So I always tell clients you should always take distributions and send them directly to your accountant, and no one ever takes me up on that. I don't know why. But I
say that about the lease negotiator too. And
so to the doctor, I would tell you that it really does not make any difference. So in any year, you are taxed on the distributions you could have taken, not what you actually took. And there's actually a section on your tax return to keep track of it so you don't pay taxes twice. In other words, let's say that I had a $100,000 profit in my practice after paying my S Corp salaries, and now I have $100,000 in the checkbook. And we now go into January of the next year. It doesn't make any difference that I didn't take it in December. And if I do take it in January of the next year, it's not taxed to me in that next year because it was already taxed to me on a K-1 the prior year. So whether you keep the cash in your practice or whether you keep it in and take distributions from a tax perspective is immaterial. It's now more of an investment question. Where is that money going to be putting to better use for you?
Got it. Great. Hopefully that answers your question, Dr. C. Dr. P back again. Thanks for that. So not leasing that $2.3 to $2.5 million business if memory serves as part of that build out. I'm assuming also includes the building. So that's key as well, though. If you're making that sizable of an investment, no different than going through your will and estate planning and all those type of activities. As Bob said, emphatically yes, to make sure that you've got that proper lease in place. It only makes sense to make sure that there's clarity in all those different types of situations.
That is definitely the size of a project you'd want to be doing a cost segregation study on, because again, with a 20% minimum turning into 5-year depreciation items, it would be an enormous tax deduction and a big help with the new project from a cash flow perspective.
Dr. G, a QBI question. So if, Bob, you have investments and the income from an S Corp, and investments are more than the QBI limit, can you still use QBI deductions?
Now, if your investment, if your total taxable income exceeds that 429,800 number, because you're a professional, all physicians, dentists, accountants, attorneys all got stuck in this QBI rule. You'll notice that Trump made certain that rental income is unlimited. So you can have $2 million of rental income as a business owner, but professional income, unfortunately, is not. So I would say that if you're over that limit, no. But again, that's the perfect time. But you think back to that same example I just used. If you were contemplating the purchase of a new laser or whatever, what a perfect time to balance and see if this is the year when buying that equipment would pull your income down just below, and now you would qualify for that QBI deduction on your dental income.
Great. If that answers your question, Dr. G. Dr. W, I purchased the building my practice is in January 2020. The building is 18 years old. Can cost segregation still be used? So purchased in 2020, but it's an 18-year-old building.
Yeah, the building could be 300 years old, but it was new to you in January of 2020, and that's the key. So it's whatever its value was in January of 2020 that you'd be breaking down into those pieces. So absolutely, yes, the age of the building is immaterial.
What about on the leasing front? A lot of doctors these days are, paying $500,000 million to buy the practice from Dr. Smith, who might have been there for 30 years, and it's new to them as the new leasee, the new tenant. What is that still applicable in a situation where the doctor buys a practice and assumes the lease?
If they assume the lease, as long as the leasehold improvements are also announced in the asset purchase agreement, then yes.
Got it. Great. That's something I'm sure is not well known. Okay, next one from Anonymous. Who does cost segregation analysis? Bob, you touched on that briefly. And really, how do they get paid? As a percentage of what they save you? Walk us through a little bit about the next step for those that do want to do a cost segregation analysis.
Sure. There's actually, there are all engineering firms for the most part that do these studies because they're breaking apart the blueprints and trying to break it all down. It's a professional fee, and I say the minimum starts at probably around $5,000 to $6,000 that I've seen. They go up from there, but it's not really a percentage of what they save you. It's not a percentage of the building cost. It's just the bigger the building, the more you have to break down and counting outlets and counting all the individual linear feet of trim and carpeting and things. And so the bigger the building, the more expensive. But I would tell you that in a $2 million building, that in $2.5 million in the one example that you would said in a previous question, even if it costs $10,000 to do the study, I would guarantee you that if you pick up a $500,000 tax deduction all in the first year, it would be worth paying $10,000 for the cost of the study. But there's several firms. If you Google cost segregation services, we use a company called CSSI, it's Cost Segregation Services Incorporated. They've been very effective and very good to work with. But there's a lot of firms out there. You can you talk to your accountant. I'm sure your accountant probably already works with some firms that they're comfortable with.
Great. A couple of questions in the chat. Will we get a copy of the Zoom? Yes. You can also email us at info@cirrusconsultinggroup.com, and we can certainly connect you with the link as well. A follow-up question on QBI. A doctor who recently just bought a startup practice and would like to know more about QBI. Bob, where can you point them for other courses available, let it through Schein or otherwise, to help study more about QBI?
The IRS does actually have a publication. If that particular doctor, our email addresses were up there. If you shoot it to me, I can send you a link. I think though that the QBI, there's a couple different courses that are available online. So if you again Google that, if you just Google a course typically on QBI, you'll come up with a lot of different hits. There's quite a few out there.
Another QBI follow-up question from Dr. P. If your income is over that QBI limit, is it beneficial to pay your associate, whom is your spouse, more than to reduce the practice income? So now we're looking at two spouses, both dentists, right? Now in a joint filing situation, presumably.
Yeah, and unfortunately, the answer is probably not, because if you're spouses, you're probably filing a married joint return. So if I take it out of one pocket and put it in the other, it doesn't really take it off the tax return. It just puts it in a different column. So not really.
Perfect, Dr. P.
And can I just back up one quick second though, Derek? One of the things we talked about equipment, but for someone like Dr. P, remember that you could pay, for instance, a year's rent in advance. If this December 31st, I paid my landlord all 12 months of 2022's rent in advance, would that get your income down below that magic $429,000 limit? Is that enough to then have you at least generate a QBI deduction this year? You wouldn't get it next year because your expenses went down because you have no rent. But I mean, look at the potential to pay expenses in advance. Look at the potential to maximize or increase pension contribution deductions and do other things that would lower your taxable income so you could qualify for QBI.
Do you typically see that at year end, a large surge of doctors hiring us just for expenses in preparation for negotiations in the following year? Follow up on the QBI. Is QBI indexed between 329K and 410K, Bob?
Yes, and so it starts at 329, it's 100% QBI, the full 20%, and it fades out on a linear basis to 429. So if you're halfway between, you'd get a 10% QBI deduction.
Got it. Just a couple of additional ones. So follow up from Dr. P. Are there specific engineering firms that do cost segregation analysis for only dental offices? I don't know that there are anybody that specializes in only doing dental offices. I know that the ones that we've worked with for many years in the past do a lot of dental offices, and so we're very comfortable working with them. But I don't know that nationally if there is a company that only does dental. Got it. Great. Another new question from Anonymous. How do you determine what is a fair W-2 compensation? If your practice profits $700,000, how much should the doctor allocate to W-2 and K-1 compensation? What's fair, Bob?
Well, again, there's court cases abound about what is fair. The answer, we know it's not $25,000, and we know it's not $700,000, that it doesn't have to be the whole thing. Clearly, a huge portion of someone who's making $700,000 a year is making that because of their entrepreneurial expertise, not just because they put gloves on, right? You're managing hygiene revenue, you're managing associate revenue, you're doing some other things that are improving that. So, most people argue that the easy, cutoff points is to say, well, 51% salary and 49% and K1 income will keep you out of trouble. But I would argue that if you want to be more aggressive, the Department of Labor publishes every year what the average dentist makes. And if you look out there, it's unfortunately, it's about $180,000 a year, 179, something like that. I would argue that as long as you're beating what the government is posting as saying this is what the average dentist makes. So if you made $200,000 salary and took $500,000 in a K1, it'd be really hard for them to argue, decidedly that was too aggressive because you're paying yourself the average.
Great. And then back, Dr. G from a little bit before appreciates your help and also asks Bob, how much would it cost for you to review tax returns and or what's the process for those of you, for the doctors out there that would like to connect with you and or become a client of yours?
Yeah, if you just email me and tell me a little bit about your situation, I would say that for anybody who's on the call tonight, we would certainly have one of the partners at Pilgrim do a complimentary tax return review for you if it's something you're interested in, but just reach out to us, and if we can help, we'd be happy to.
Awesome. Great. I know, Bob, you typically these go on and on and on, and you've had a few that have gone into the hours later. Appreciate almost all the doctors are still with us here. I think the last question we typically get a lot of, Bob, is lots of thanks to that from Q&A. A lot of questions around transitioning, timeline, preparations, etc. Let's say you've got a doctor that's 10 or 5 or maybe even 2 years out. What sort of guidance would you give to a doctor that's looking to transition, let's say in 10 years and sell the practice, right, versus potentially in 2 years or 1 year, and they've waited till the last minute in terms of preparations? How would you give, what guidance would you give to those two different doctors?
Yeah, well, obviously the best advice is plan early. Clearly, if you're trying to sell your practice all within 1 year, you're going to miss opportunities, because what you want to do is make certain that your practice is still very relevant, relatively modern. It's not a big mistake to let your practice just age with you. You've got to keep it relatively up to date. It doesn't have to be all new chairs and x-ray units every year or anything like that, but it does need to be, quote, up to date. And the other thing is that make certain that you've maximized your profits. Again, if you let the practice just kind of slowly go off in the distance as you age, you're minimizing your practice value rather than maximizing it. You want to make certain that when you are ready to retire, you've done it at a time when the practice value was maximized. So keep working hard. If you think you want to slow down, hire an associate or sell the practice then, and do that while you're at the actual peak. But, again, it's different strategies. If you only have a year to go, you just need to hurry up and get some brokers and get the practice polished up in its best possible light, and see if we can gather some buyers.
And to that same question, similarly, the lease, right? A lot of the lending partners out there, especially the large ones, if there's insufficient term on the lease, right, then the underwriters will not approve that loan. So a lot of doctors think, hey, great, when I'm about to sell my practice, Bob, hey, why don't I just go month to month and all that flexibility? But don't forget, what's your practice worth without a location, without a key? Right? So from that perspective, very important to, as you're looking to transition, term could be very beneficial for you, as well as options, and more importantly, transferable options. And especially those of you on the West Coast, a lot more common to see the options being personal to you, the original dentist, which wouldn't benefit your potential future buyer. So really don't underestimate all this hard work to save all the taxes. But again, at the 11th hour, if that buyer gets scared away because of continuing liability, and you're trying to negotiate at the 11th hour and the buyer gets run off, right? That there was a couple recently with the practice transitions team that we've worked closely with. Definitely take the time to prepare term, transferable options, and obviously an assignment clause to help limit any personal guarantees, continuing liability, and to give you a clear path through an eventual transition. Think about a properly structured lease as a protective force field around your eventual practice sale proceeds. Perfect. Again, for all the doctors that are still with us, really appreciate your time. Bob, can't thank you enough.
Thank you for
honor.
Having me. I appreciate it.
Greatly appreciated. Again, all the emails are up here. I do typically spend an extra half hour for anybody that has an urgent situation, or those of you that are worried about losing sleep tonight based on some of the things you might have found in your lease. don't hesitate to email info@, that goes directly to my inbox, as well as happy to receive any extra calls as well. Really appreciate everyone's time. And that's it from us.
Perfect. Thank you, Eric, and thank you, Bob, for the great presentation tonight. If anyone has any outstanding questions, please email us at webinars@henryschein.com. As a thank you for attending, everyone will receive the recording via email in the next week. So thank you all for joining us, and we look forward to seeing you on future webinars. Have a good night.
Good night.